Ladies and gentlemen of the crypto space, we're live on a Friday, February 10th at 1:36 p.m. It's been a long day for me, a lot of coding this morning. So please pardon my lack of energy. I will do my best to tell you current conditions. Conditions tell you where we are. Conditions contribute to speculation on directionality. And the better we understand conditions, we get a sense of, well, literally directionality. So it helps in the speculation process. Now, I don't really talk too much about speculation nowadays, but in order to do any speculation, you have to understand current conditions. I love understanding current conditions, and I have spent the entirety of 2022 setting up my portfolio, my capital management structure, everything I've done, such that I don't have anything to do with regard to speculation. Or at least I've minimized everything I need to do with regard to speculation. I have maybe one or two considerations here or there. The vast majority of my structure is aligned to the overall market directionality over a 5-10 year time horizon. And I have the capital flow and I have the income, so I can make potential speculative plays if it's a very obvious play. I'm kind of digressing from where I wanted to start the stream, but ultimately, if you have cash and you have a ridiculously awesome trend setup, what I would say, an ascending triangle with great structure, then you can make some cash from a capital gains perspective. But unless I see those ridiculous large ascending triangles that we've very much seen throughout history, and we certainly saw a build for weeks, if not months at a time in 2020 in the crypto space, I'm not going to take no directional speculative positions. So let's pop it over to the main screen and assess our current conditions. So currency volatility is just 1 degree before risk volatility. This is where risk is under pressure today. For the last 1, 2, 3, 4 days, the dollar has been below the 50 SMA on the daily, and it's pushing above. And that sends a chill down the spine of risk markets that they will need, that people are going to come for their risk assets to acquire capital. So right now the world is buying dollars because they need dollars. The implication is that they need dollars. So if they need dollars, where do you get dollars from? You sell shit. So first and foremost is money. Bonds are money. So bonds are sold for FX dollars in this instance. So let's take a look at bonds, 10 years. So 10 years are up today. This is the daily chart. So bonds up implies they're being sold. The yields are up. So the price point is down, which means they're being sold. And if we see the dollar up, the bonds are being sold for dollars. Now, typically, if bond prices are down, that is a discount on euro dollars. That means they're cheaper. So if currency's up and bond prices are down, that sets up the conditions you need for reversal. Because if bond prices are down, you have a cheaper euro dollar than the FX dollar, which is now appreciated. This is what I was just tweeting about. But if you look over at oil, there was a nice pop today. This is the daily chart yet again. Now, daily chart is a bit of it'll drive you nuts looking at daily conditions. The daily chart's not going to give you potential directionality. You really want the weekly to get a sense of directionality, and even the monthly if you want to maintain a bit of sanity. But your pop today, I would argue, pop today in currency volatility, I would argue, has more legs because oil is up. It means that the bonds are being sold for dollars because energy is priced in dollars. And when you're going to buy energy, what does an energy supplier want to be paid in? Dollar FX rather than dollar liabilities. More likely than less. Obviously, it's however you sell your energy is the condition of the seller. But that is just a rational observation that you're going to want that type of payment. So that's why this type of condition suggests to me that currency has more upward pressure than a potential reversal. So I'm eyes on oil prices coming down a bit, and that would relieve pressure on dollar forex, especially with yields going up. If yields keep going up, you have an increasing discount on dollars. Yields up pulls pressure off of dollar forex. And that's interesting because that's the Fed narrative. The Fed narrative is higher for longer. Now, I question whether the Fed's narrative for higher for longer is for inflation. So obviously it impacts inflation. Higher for longer impacts domestic currency availability and potential solvency. So that's another story if we head down the road of a solvency crisis because of rates. But it also decreases the potential for capital expansion. If something is more expensive, you can't. Capital is more expensive. That's the whole point of higher rates. So it constricts the potential liquidity expansion domestically. Internationally, it makes euro dollars cheaper when bond price yields are higher. So higher for longer improves the disinflationary pressure of currency availability around the world. So higher for longer is a very interesting narrative, and ultimately it changes the entire capital flow dynamic. If liquidity is constrained inside the United States, but liquidity is allowed to expand internationally, that means there's more capital internationally in aggregate, which means things are going to appreciate internationally. And what happens with capital flow? Capital flows from constricted liquidity environments to liquidity ample environments. Because there's more capital, it drives the prices of things up, so they're outperforming, and capital flows from underperforming to outperforming. So the higher for longer narrative is an emerging markets play. The capital is going to flow outside, from inside the U.S. to outside of the U.S. Now, we haven't seen this in a long time. Brent Johnson made a nice tweet today. If you did an emerging market play compared to U.S. play over the last decade, you lost out. And it's because of the bond rates. It's because there was no discount on euro dollars. It was constricted currency supply outside of the United States. Now, you don't make a play based on the past, or you don't try to assess directionality of the system based on the past. It was a nice chart he presented, but conditions today indicate that directionality, or the way the system, the way the liquidity flow around the world could change. And that's how you speculate. You speculate, does a direction that the way things have been heading, can it change? Can the conditions induce that kind of change? Now, I look at the monthly chart for the 10-year, and we're in pretty much a situation where conditions suggest we could have a significant change in the structure of capital around the world. For the first time in 40 years, we have a meaningful breakout on the log trend, including from a Fed funds rate perspective, which implies that their policy is structurally changing. You had lower highs after lower highs, and you finally have a higher high. It's not a lower high. It's the first time in 41 years where you have a significant higher high as compared to the last high of the rate hike cycle. This is a structural break, and this has implications for capital flow worldwide. So regulatory, maybe that's too much of a digression. Sometimes when I make the title of the streams, I put too many topics in. Now, this is the most important thing to me, is understanding liquidity and the flow of liquidity, because if you want to understand the crypto markets, you have to understand the liquidity in the market. The liquidity has been sticky and captured by the market, and the potential flow of liquidity into versus out of the market. Right now, it's still a negative sum game. PvP, player versus player, predators, concentration of capital. And when you have currency volatility like this, that's why you see the pronounced volatility in risk assets. In a constricting liquidity environment, when volatility presents itself, fewer and fewer people have more and more capital, and you have significantly greater price swings, which is exactly what we're seeing. I mean, we had like a nice 20% dip. We're up at $1.20, pushing above the 50 SMA on Curve, which I would argue is the primary currency producer of the crypto market. So this I consider the chart of truth in many regards, because it issues currency, it has a currency recycler, you know, the whole story that I talk about. So it's not really Ethereum and Bitcoin that I think are the most meaningful charts to understand where crypto is with regard to conditions and directionality. Well, let's look at Ethereum real quick. Support on the 200 EMA on the daily. Support on the 200 EMA on the weekly. Support on the 10 SMA on the weekly. So technically, what have I always said? When you hit support, it's a position of defensiveness. It's not a position of strength. So right now, markets are testing, do they want to go lower? It's not do they want to go higher, it's a position of weakness. So it's nice to see the 10 SMA on the monthly inclined upwards. It's nice to see green guppies reemerge. It's not promising of upward directionality, but it's suggesting potential continuation to the upside. We're still below the TWAP on the monthly. If we go to the weekly on Ethereum, still below resistance, as I said, above the 200 EMA, below the 50 SMA, below the 100 SMA. We're still in red guppies territory. Red guppies in this particular positioning is kind of pressure coming out of the system. It'll be nice to see when if this goes flat, if we don't see a meaningful leg down. And this could just trend horizontal and turn from red guppies to gray guppies for a couple of months. And you see, you know, giant crab season. And that would be interesting, which, you know, in a basically a zero-sum situation, horizontal price action is relieving, and that's good to see. Ethereum and Bitcoin are a bit different as compared to other assets we look at. When we look at things like Curve, I've been looking at Aave lately with their stablecoin release. But when you look at anything that's part of the Ethereum ecosystem, it's different because that you have to look at stablecoins and liquidity thereof. Ethereum and Bitcoin, you're not looking at necessarily stablecoins because those are more macroeconomic type assets that are highly affected by liquidity flow to and off of centralized exchanges. So they have a different source of liquidity. They have dollar liquidity, whereas altcoins are really, we're more so looking at stablecoin liquidity. Just something to be considerate of. So there's a different consideration when you're looking at altcoins versus Ethereum and Bitcoin. And it's a whole other story when you're looking at altcoins on L2s. Because altcoins on L2s, you're not looking at macro capital flow like to and from Bitcoin and Ethereum. When you want to think about liquidity on L2s and alt L1s, you're really talking about a drain on liquidity from Ethereum mainnet, in my opinion. You're really looking at stablecoin liquidity. But where's the first place that stablecoin liquidity is deployed to? It's deployed to Ethereum mainnet, and then the alt L1s and the L2s draw on that liquidity. It's kind of like an emerging market of emerging markets. It's kind of like a country and provinces, a country and states, country and cities. That's the type of mental imagery that comes to mind when I talk about this shit. Let's answer some questions and maybe we could hit on regulatory considerations if my brain has any energy left. The Hook's in the house. YS, a pleasure. Good evening. Your thought process on portfolio management is pure gold. I'm still a work in progress. I'm still a work in progress. But the most important thing is sustainability. Contributes to survivability. That's why I look at conditions. Conditions give me comfort. If I understand the market that I'm engaging with, I understand what it's doing, why it's doing it, I can find my comfort zone. Where I'm like, all right, this is why it's doing this. And, it doesn't mean everything goes to zero. It doesn't work like that. There's a tremendous amount of liquidity. The liquidity has been captured. It's sticky. There's plenty of reason for volatility. Why? Because we're looking at the reasons for volatility. It all starts with bond volatility and carries over into currency market volatility. And really, it's all about energy and demand and need to purchase energy, which kind of drives all of this volatility. And there's an argument back and forth, which is the inducer of volatility and which is the knock-on effect of volatility. Bond prices surely have a capacity to suppress or add to volatility. If there's volatility in any of these markets, there's knock-on effects everywhere. But as I've said, depreciating bond prices relieves volatility everywhere because it significantly increases currency internationally. It's a discount on dollars. It relieves all the volatility pressure on Forex markets as bond prices continue to come down. So it gives me a great deal of comfort to understand these conditions, and that's why I'm increasing my capacity to navigate these markets and survive, and that is what leads to success over years. 5-year, 10-year type plans. Hope that helps. Tapsy, hey Noah, how's it going? Exhausted today. I got some more coding I probably have to do after this, so it's been a long day. And I have these regulatory considerations that I'll try and talk about. Was just listening to your video with Miss Rational, and it was fantastic. I've been trying to get more time with my lovely wife. It was really good. It's important content because she, and as well as other people in the community, are constantly encouraging me to have more of that type of conversation of how do you get into capital management. And I would like to have more conversations along those lines because you can't just sit down and be like, oh, I'm going to manage capital. Everyone really starts with, what am I going to buy? And that's really why I was talking to my wife about it's not about buying. The first thing you do is not want to buy. You have to start thinking about how you buy things. And that was really, what I tried to hit home in that conversation. I'll try and do more conversations with her. It's pretty good. She does ask the right questions, and I'm sure she's going to hit me next time with, what do I buy? And I'm going to have to present that in a digestible way. I'm really looking forward to stuff like Gamma Swap and like more advanced market making systems. I really think, I would say the crypto space, but I really should be saying the world. The world needs a better passive place to allocate capital because it surely isn't a bank. So how do you have, a risk minimized deployment of capital where there's risk to your principal? You deploy like 10 grand and your principal could fluctuate 5%. But if the principal's fluctuating 5% and it's giving you a return on capital of 10%, 15, 20% per year, all right, principal, go do your thing. Plus or minus 5%, all right. But as long as the capital is productive, producing 10%, 15%, you could process and accept the volatility on your principal. It's interesting, talking about risk-free, and that's what we talk about with regard to bonds, but it's not productive, and it has negative real yield for the vast majority of our most recent history, and we're in positive real yield territory, but it's not really positive real yield considering on the ground consumer price inflation. So it's a whole lot of complex talk. And I really like talking on my stream because I get to talk about these complicated things. And as you were saying, Austin, I really like to talk to my wife because it forces me to give that more of a simplistic presentation of these extraordinarily complicated mechanisms that make up the functioning of our world. One curious view, a pleasure. You going to talk about GHO when it launches? Yeah. Um, so I have to be a reductionist with regard to Aave. I have a high opinion of GHO because we are in desperate need of a capacity to create currency, whether it's internationally or domestic U.S. So many folks have a negative opinion of the dollar, but I think they do a great job from a Keynesian economics perspective of managing currency. Most people don't understand currency and they think, oh, they just print. It doesn't work like that. The national debt is international currency, and there isn't enough international currency. How do we know there isn't enough international currency? Look at the damn DXY. That's how we know there isn't enough international currency. This is what is crashing all the damn markets. The demand for currency. What do you think happened in 2022? The dollar, there wasn't enough dollars. And that's why the stock market, of all the people that are like, oh, they print too much dollars, that's why the stock market's doing what it's doing. There's not enough currency. So technically, there isn't enough international debt. Our national debt is too low. And it presents complexities from balance sheet management perspective. Um, and it presents complexities with regard to the debt ceiling and solvency of how do you pay that debt, but you could create the debt. And there's a currency printer, so it's just too much animosity towards the system, in my opinion. Because at the end of the day, you all want dollars because you all want to buy an egg sandwich, and everything at the grocery store is paid for with dollars. So everyone hates on the dollar, but you sure as hell want the dollar. So that's a bit of a complexity there. The problem is people. People are the problem in everything, and that is why for myself, find the crypto space to be the most comfortable market to engage with because the optimal and most meaningful systems have removed people from the enterprise equation. Imagine if the Fed was just a relatively sophisticated smart contract and there was no people. And raise rates, lower rates, it was all just programmed. And you can't point at Chairman Powell anymore. It's the algorithm. The algorithm is screwing the country. No, it's a freaking algorithm. You take people out of the equation and it's a whole different argument. There is no argument. It's the software. And it's going to do what it's going to do deterministically, and that's beautiful. That's why certain allocations in the crypto markets are so different than everything and anything on the planet. You take people out of the equation, it's a whole different story. Now, that's why I've talked lately about allocating capital in crypto, and that brings up the whole regulatory consideration. You need disclosures for a completely transparent, on-chain, immutable smart contract. I mean, sure, it'd be nice if when the contract was deployed, there was, some sort of instrumentation panel that gave you all the data about what's going on with the contract and what it's doing. I mean, all right, fine, maybe we're looking at that. I mean, this is everything that's going on with the system. This is Dune Analytics for Curve Finance. This is disclosures. There's no people to ask for this. There's no people that you have to yell at from a regulatory perspective to update this information. It's all here. Here's the monetary policy. Here's the emissions rate. Here's the lock rate. Here's your staking. S-T-A-K-E-I-N-G, not S-T-E-A-K like Gensler was talking about in his first grade style conference or video that he put on social media. Um, and this is partially STEAKING as well. But staking, STEAKING, is monetary policy. What do you think they do when they're issuing interest and inflating when M0 goes up? When M0 goes up, M0 is currency units relative to GDP. If you increase the amount of currency units in circulation relative to GDP, there's your staking that he was talking about. So everything is the same story. And what frustrates me is when people try and isolate like crypto as being something different and new. And in many regards, it's the same system. It warrants the same type of conversation. And what I've identified and highlighted so vigorously in my content is, what is the difference? And the biggest differences are not monetary policy. The biggest differences really are immutability, deterministic execution of code, permissionless access. Those are the biggest things. So if you're looking at protocols, back to like Austin's point, where I should talk more with my wife, is how do you evaluate potential capital investment? Immutability, determinism, and permissionless access. That's the biggest consideration from a survivability standpoint. If it's not dependent on developers to unfuck something and it's just going to execute deterministically 5, 10, 15, 20 years from today, it's going to survive. That's a very rational reason to allocate capital. So what has those types of characteristics? Obviously, Bitcoin, Ethereum, and some, not too many, but many altcoin protocols, smart contract implementations. And that's how you minimize your risk profile. When you're deploying capital to protocols that are dependent on continued developer activities, that increases your risk profile. I'll talk more about this with my wife when I get more content out. So one curious view, GHO. I like it. We need more currency units, but Aave is kind of uninvestable like Uniswap. Now, they talk about you could turn on the fee and Aave, you could vote for a distribution of capital. Then you have the whole growth stock story that everyone talks about. Take that treasury of Aave and focus on development to make a better product. And then it comes back to me as a growth investor or a value investor. And I don't give a shit about growth. And what do I mean by I don't give a shit about growth? And we could go to my pinned tweet, which I think about changing every now and then. But then I come back to these 3 sentences, mostly complete sentences, express my investment thesis the best in the shortest amount of words. You want me to invest in your company. How much are you paying weekly? 0%. But the growth of the stock price, fuck you, pay me. I don't give a shit if something is expected to go up 100% on the money because of stock buybacks or reinvestment in the company. No, give me some goddamn money at the end of the week. How much are you going to give me? That's my investment thesis. I don't want growth. I want a paycheck. That's the bottom line. So that's my opinion, unfortunately, about Aave, which I think is a meaningful protocol, which is why I keep coming back to it and considering it. But I just can't get over the fact that I can't get 20, 30% on the money. So I can't deploy, because that's my thesis. And if you need to find your thesis and don't deviate from it. If you deviate from your thesis, you're in uncharted territory for your comfortability. Because we go back to the beginning of the stream. How do you survive in markets? You have to find your comfort. And then I went into understanding conditions, understanding the financials and the macro, and that gives me comfort. Being consistent with how you allocate capital contributes to your comfort. You're not stepping out of your comfort zone. Is the price going up? A long position, a short position. Do you have to buy? Do you have to sell? It doesn't contribute to your comfort level. If anything, that contributes to anxiety. So, survive. Curve USD? Oh, I'm sure it's going to be immutable. I'm sure it's going to execute deterministically. I'm sure once it's deployed, you can't modify it. Immutable. Now we're talking. And what is Curve USD going to contribute to with regard to capital to value, capital flow, cash flow, payment? It goes to the admin fee. It gets deployed. There's a button at the bottom of the Curve website that you'll click on, and the money, the value that Curve USD produces is going to be available at that bottom, at the bottom of the website every week, and you're going to click it, and it's going to pay you. Now, obviously, it's complicated from a capital allocation standpoint because you need a fair amount of it. You got to remember, 20% of the money is extraordinary. But 20% on the money every year on $100, you're making $20 a year. And this comes back to another point that I mentioned on Twitter posts, how to assess, can you even attain a reasonably sized position? And further, this plays into stuff I have to talk with my wife about. How do you think about getting started in investing? Because what's the point of an investment if it's not going to achieve what you're looking to achieve? So this plays into expectations. And expectations plays into survivability. Because if your expectations are too high and you're not achieving them, you're not going to last long. You're not going to survive the markets. So as you can see, it's all one giant feedback loop of trying to figure out how to engage in markets. YS, ZK rollups will bring deep liquidity between each other, sharing huge liquidity pools for the usage of those L2s. That is a very big sentence that has a lot of hyperbole. Deep liquidity, sharing huge liquidity pools. When I see deep liquidity and huge liquidity pools, then I will be interested. Where will we see that deep liquidity and those huge liquidity pools? In the stablecoins. One page. This page will show you everything. This page shows us that there is $80 billion worth of liquidity on Ethereum mainnet. And we've seen a lot of excitement, a lot of activity, a lot of appreciation on Arbitrum that has $1.12 billion. That is 1/80th the amount of liquidity on Ethereum mainnet. So sure, that is an exciting environment. But guess what? It's PVP. 14%. Okay, it's not PVP. So that is actually quite interesting. You have a significant increase in available liquidity. But the big potential remains on Ethereum mainnet. Optimism, 6%. So we're seeing basically Phantom, kind of boring. Avalanche, it's interesting. Arbitrum and Optimism. So what does this mean? This is an L2 season, a little micro mini L2 season. If you got 14% increase in liquidity on Arbitrum, that's a big deal. There's a lot of capital to be made. But it's not going to be the big capital. You're not going into Arbitrum with $500 million and going to double your money. So this is actually, from a quantitative perspective, a good opportunity for small actors. This is a perfect type of environment to turn $1,000 into $10,000, $10,000 into $100,000. But bear in mind, it's still PVP. Why? If there's an increase in liquidity on Arbitrum and tight liquidity conditions on Ethereum, the gains that are made on Arbitrum are going to flow back to Ethereum. Because there's gains here, there is yet to be gains on Ethereum mainnet, which means the opportunity remains for capital inflow on Ethereum mainnet from the rest of the world, which has, 30% increase in liquidity from 2020 if you look at USM2. So the capital flows to where there is opportunity. Because there has been outperformance in these markets. These markets will experience exuberance again. We just have to look and wait for opportune macroeconomic conditions, which is exactly what gives me my comfort and why I look at all these damn macro pieces of data. Lucas, the Ethereum DCA might be riskier to be more bearish than bullish with global liquidity increase, right? Well, I'll save this conversation predominantly for my wife. We'll talk about that and get the content out. DCA is nice because DCA you could do from a low anxiety perspective. You have an extra $500 a week, $500 a month. And if you take $50 of it, it doesn't significantly impact your overall balance sheet for the month. It's 10% of your extra capital for the month. Take 5%. I understand 62% of the American public is living paycheck to paycheck. You could carve out $5, $10. How do I know that? I'm an intermittent faster, skip breakfast. So bear in mind that's also healthy. So now your DCA is healthy. It's healthy to skip meals because it's all about caloric balance on a daily basis. So if you skip breakfast and now instead of 3,000 calories for the day, which is very unhealthy, well, you have 2,200 calories for the day. So you just skip breakfast, reduce your calories for the day in a more healthy caloric balance, 2,200 versus 3,000, and you are able to accumulate some assets that have a more likely than less likely chance of appreciating over the next 10 years. So in that regard, Lucas, fine, DCA. And if you live in paycheck to paycheck, how do you do it? Skip breakfast. I don't eat breakfast. I've lived my life in many different ways where I've been extremely overweight. I've lived my life in calorie restricted ways, and I personally think I am most healthy when I don't eat breakfast. Now, obviously, that's a very complicated, in many regards, a personal topic, and I'm not going to go any further into that. But that's a great way. Where do you get extra money? Skip a meal. Most Americans are obese. That's quantitative. So skip a meal. Living paycheck to paycheck, there's an extra $10. Buy something that has a hope, a potential to go up in value, and then there's your DCA strategy. I don't want to get too personal. I know it's an emotional topic. The sad thing is that Japan holds 50% of its own debt. Yeah, it's very complicated what's going on in Japan, and there's plenty of reasons for them to continue to depreciate the yen, which is obviously appreciative of the DXY, and it has significant impacts on global currency balance. And the bottom line is the world is dependent on dollars because the vast majority of energy is priced in dollars, which is exactly why Saudi Arabia, China, India, Russia, Brazil, and that's why they're all talking like this. But if they all of a sudden stop buying, this is what Luke was talking about. Luke Grumman was talking about the other day on one of his podcasts. If you stop buying energy in dollars, what happens to dollar liquidity? There's a huge amount of dollar liquidity available. What are you going to do with liquidity? What do you do with liquidity? You buy shit. So all of a sudden, it changes the whole balance. And that if you have extra dollars and you have extra dollar liquidity, now that further entrenches. And now all of a sudden people want to denominate things in dollars because that's what's available. That's what people could pay with. Very complicated. De-dollarization is not as simple as most people think. And the dollar is not as bad as most people think. The weaponization of the dollar is a complicated geopolitical topic. Bear in mind, the only reason you could weaponize the dollar is because the world has opted in to it being weaponizable. Complicated. Damien, apologies if you already discussed this, but any thoughts on CVX CRV being off peg for weeks? It's not a peg. Very few things are meant to be pegged in the crypto markets. Now, obviously, there's organic arbitrage and the liquid derivatives, especially of the currency producers. So Curve is a currency producer, and Convex is like a sovereign of Japan, and they're accumulating reserves. And there's no reason for them to be on peg other than natural arbitrage depending on incentives. And really, it reduces to directionality of the market. If there was significant liquidity inflow and there was ample positive sum game type environment, that would be a much more closer one-to-one. but it's not a peg. There's no active AMOs like with the Frax. Frax is probably one of the most interesting protocols in the crypto space. Now, obviously, it's complicated from an immutability standpoint, so that increases the risk profile, the enforcement action footprint. But it is one of the most advanced protocols with regard to its stack of software offerings. So that's why we've talked about it over the years and why I take meaningful interest in it. Hope that helps. Regarding ZK, I was pointing new solutions for the liquidity problem between Ethereum and L2s like Arbitrum and Optimism. It all revolves around Curve. As with everything, it all reduces the Curve. Curve is the centerpiece of currency creation within Ethereum, which means within all smart contract networks. And it just is what it is. It's like when folks talk about the dollar and say, "Oh, the dollar is going to zero," or they're going to de-dollarize. And they're not de-dollarizing, and the dollar is not going to zero. The dollar dies when it goes to 500 on the DXY. And it's the same thing in my mind with regard to Curve. Curve's going nowhere because it has all the stablecoin liquidity, the meaningful liquidity, and it's the payer, it's the currency producer. Anyway, so that's the bottom line. Is it better to be bearish now or bullish for cryptocurrencies? Well, liquidity isn't going up. It's kind of like understanding international versus domestic liquidity. So domestic liquidity, if we go back to DeFi Llama, so domestic liquidity is overall flat. If you look at Ethereum mainnet, it's about flat. It's marginally negative sum game. But if you look at the states within the Ethereum country, some states are significantly outperforming. So Arbitrum and Optimism has received a significant amount of capital inflow from the country, which is quite interesting. So there's meaningful opportunity right now in Arbitrum and Optimism. But that is going to be PvP because the country, it's kind of like talking about the states in the U.S. in recession versus the countries in recession. States can be outperforming, but if the entire country's in recession, it's going to throw off opportunistic capital flows. Because when there's capital gains on Arbitrum or Optimism, people are aware of the overall liquidity situation in the entire ecosystem, and they're going to be risk off. They're going to be taking their capital off of Arbitrum, off of Optimism. It's going to be very PvP, very predatorial. So just be very careful. There's good outperformance, but it's going to be very, very predatorial. So is it better to be bearish or bullish? I'm neither ever bearish nor bullish. I am an observer of current conditions. Liquidity is actually going down. Liquidity in the world is going down. Relative to the highs in 2021, liquidity is down globally with regard to M2. Relative to the start of 2020, liquidity is significantly up. So negative sum or positive sum game are dependent on the time period in which you're looking at the overall system. YS, hope that helps. Alan, you talked about Curve not being the best option for smaller players. Where would you draw the line? Draw the line based on your own needs. So I've said a phrase recently, cash flow cost averaging. So if you only are looking to make an extra $100 a week, and that's a significant number, that's cool. Think of things as purchasing cash flow. If you're thinking of something that gives you money on a weekly basis, that's a reasonable, rational way to deploy capital. Now, with regard to volatility, price point, that's the entry calculation. You've chosen to target capital deployment to value. Value is things that pay you, not a growth stock, but something that pays you on the weekly. That reduces the complexity to entry, and that's volatility of price point. So if the price point is going to go down, that's an opportunity to buy value that pays you on the weekly. How much do you buy is dependent on how much you want to make on the weekly. Complicated calculations, but if you're looking for $100 a week, come on, that makes a big difference. $100 a week pays for many car payments, $400 a month. Now you have to take into account income tax, depending on your capital structure. So that's something I'll get to. Conversation. We've talked about it, whether it's corporate or a trust. There's plenty of different ways to do asset management and capital management. I was talking to a colleague at the office the other day, and I mentioned my relatively complicated capital management structure. He was like, "Oh God, that's so complicated." It is. The more complicated it gets, the more benefits you potentially have. The better you can take care of your kids and structure things to protect and maintain your assets. So anyway, look, 50 grand and 100 grand is a baseline, and you're making 20%. That's 20 grand a year. That's a large salary. Relative to the world, that's a massive salary. Relative to the U.S., depending on how you've managed your expenses, it's a complicated conversation that brings up, living below your means and how well you restrain yourself from indulging. It's like delayed gratification. Do you drive a $2,000 car or a $25,000 car with a $400 a month lease payment or finance payment? So in that regard, $400 a week could be huge. 20 grand a year, 20% on 100 grand. That's pretty cool. Where are we with price point? Let's go back to the technical data. Overall, what do I see in the charts on the weekly? The rejection of the 50 SMA is meaningful. The rejection of the 50 SMA, it encourages people to think that we should expect lower price points. We're significantly above the TWAP on the weekly. The last time we breached the TWAP on the weekly in end of summer 22, we were in a very different position. We barely had any support expression above the TWAP on the weekly back then, the middle of last year. Now we have 2 weeks going on our third week of support expression on this bottom green line, which is a meaningful level in all regards, especially the fact that this week we already literally put in support at that level, coming off 2 previous weeks of support at a higher level. So what do we know? Support is a position of weakness. This is overall a position of weakness. And weakness and strength are time sensitive, so this is weakness in the short term. This is a position of strength as it's expressing itself above the TWAP much better as compared to what it did in August of last year. So short-term weakness, longer-term strength. If you see a breach down to the TWAP, that's definitely a position of weakness. So all you ever know about market directionality is, are you in a position of strength or weakness? If you're in a position of weakness, there's a good reason to suspect short-term depreciation. Short-term depreciation, maybe we find support in the 80s. Obviously, if you're talking about a value investment, you opportunistically want to buy $100,000 worth of something when it's in the most bearish situation. A breach down here, it's a 65 below the TWAP, and maybe it wicks back up to the TWAP. That'd be a beautiful candle to see. And then you're questioning yourself, what's the potential for cash flow to continue, for it to survive? And to that, we look to the overall liquidity of the system. If the liquidity remains sticky, there's a reason the liquidity is remaining sticky. Now let me zoom out here and give you all a little bit of encouraging words about the future of the crypto markets. If you go to token market cap token market cap? No, total market cap. In April, no, I remember seeing 2020. There was less than, it was like $1 million, couple $1 million at the end of 2019. There was nothing. There was nothing in the DeFi space at the end of 2019. And now we have $136 billion across the DeFi networks in stablecoins and liquidity, currency units that could be used to pay for egg sandwiches in one way or another. That's a tremendous achievement at the end of 2019. So we're talking about a little over 2 years. No, 3 years. 3 years' time. Come on. How does that not contribute to characteristics of capital stickiness in the context of framing the DeFi space as an emerging market? It's wild. Hope that helps. It's not as simple as I would hope it was, or I wish it was for everyone. But these are the types of conversations we need to have so folks make better decisions. And they're not buying Bobcoin and hoping it goes 1,000x on the money. There's nothing unhonorable or unreasonable about working and cutting expenses and moving in or moving back home or sharing an apartment so that instead of paycheck to paycheck, you just shave an extra $400 off your monthly expenses, and then you could spend 10% of that DCAing, and you have an extra $360 a month. And come on, we could do better. Don't have to be the statistic. Can make better decisions, which means living below your means if you need to. What was it, Buffett? The Munger said, you do what you have to do to get to 100 grand. If you have to walk everywhere, walk everywhere. If you have to skip meals, you skip meals. Now, obviously, that's easier when you're younger, and it's harder when you're older, especially with kids in a family. And everyone will say, I have my standard of living. Oh, the old American standard of living. The expectations. Expectations. Expectations are what hurt you most in investing. And this goes back to what Austin wanted with me talking to my wife. Most people have the wrong expectations going into investing. How many people on the stupid TikTok videos you see, I'm going to make $1 billion. The expectations are wrong. The person who's more likely to make the $1 billion is the person not trying to make the $1 billion. Buffett was not trying to make the amount of money he has when he started investing. Bottom line. He had a rational methodology. He stuck to his methodology. He refined his methodology, and he executed his methodology. That's the goal. And whatever the hell happens with your capital, wealth, is a manifestation of how well you refine your capital management strategy. That was a lot. I hope it helps. You're welcome. Alan, thanks. Plus, the Ethereum price will eat into any gains depending on how often I want to claim. So, mainnet, I know it's a complicated equation. Mainnet has very large transaction fees. There's compounders. There's the Llama Union over here. There is derivative considerations. There's obviously Cleaver nowadays. I don't know why it's the pounders. So there's the pounders, a curve pounder. There's Cleaver. What is that? Aladdin and its cohort of protocols that they're building. So that's interesting stuff. I see them as just currency consumers, but they're meaningful because they're part of the ecosystem. I know it's not easy, Alan, but answer the questions. If Ethereum fees are too expensive for claiming purposes, it might not be a good position. You might have to choose something else. But what's most important is before you engage in an investment, you assess this. Were you able to achieve a meaningful position size? Can the position even achieve your expectation? Is the expectation reasonable? Is there excessive risk associated with the position? Is there excessive risk that gets in the way of potentially achieving the expectation? Let me give a simple example. You want to get 100x on the money. You deploy $1,000 to 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 Bitcoin, and you need 100x on the money. And someone out there has $100 million worth of Bitcoin. If you want 100x on the money, you have to hold it for a long time. Do you think the person with $100 million worth of Bitcoin is going to wait for you to get 100x on the money? By the time Bitcoin does a 2x on the money, they made $100 million. You're not going to get to your 100x on the money on Bitcoin without 100 millionaires making profit hand over fist. It's not a reasonable expectation. It's missing out on tremendous opportunity. I can't be behind that. I can't ever support that investment mentality. DCAing is different because the expectation isn't significant outperformance. The expectation is much lower. The expectation of DCA isn't necessarily to make money. The expectation of DCA is more in line with Saylor. And are you going to have any money in 10, 15, 20 years when the world does start to engage more significantly with the process of de-dollarization and the flow of currency significantly changes around the world? So that is a speculative bet on not dollars and the world changing systemically. So DCA isn't about turning $1,000 into $100,000. The expectation of DCA should not be to strike it rich or make a lot of money. I'll continue to talk about this topic with the wife. How do you get into investing? And expectations are an extraordinarily important thing to digest and contemplate granularly. And they need to be reasonable and rational. Oh, Asarko's in the house. How you been? Hope everything's good. Made it live. Hey, Cap, survive the market. Earn more income and build positions for long term. What do you tell yourself? 5 years. So if something presents like it could survive 5, 10, 15 years, those are meaningful investments. So what are the characteristics that have the potential to survive for 5, 10, 15 years? Things that are immutable, things that don't have humans to fuck it up. So that's why I focus on immutability, the concept of deterministic execution. No humans are responsible for the operation of these protocols, and those contribute to survivability. Get humans out of the equation. And that is the most innovative damn thing in the entire crypto space. I hope that helps everyone. Nice conversation today. 41 people in the stream, 11 likes. We could do a little bit better. Smash that likes button. I appreciate it. Raul's in the house. Hello. Let's wrap it up for today. I will see you guys on Monday. I wish you all a wonderful weekend. Just remember, take your time. You don't need an investment. What you want to do is make good, well thought out investments. Patience. Ask questions. There's a whole world on social media of where questions can be asked. There's a whole world on Discord where questions can be asked. There's a whole community that we have on Discord where questions can be asked. And when you ask questions, you're able to make better decisions. Friday, February 10th at 2:35 p.m. Thank you all for joining me. Tell everyone to subscribe, because if they don't listen, I can't help them. After party on Discord for the most rational community in the entire crypto space. Be safe. I'll see you on Monday. Peace.